Welcome to the Deep Dive. Today, we are strapping in for a pretty high-stakes ride through the world of sophisticated crypto trading analysis. We're really trying to move past the guesswork, the emotional trading, and focus on the essential framework that separates speculation from actual strategy.
It's the ultimate reality check, really, for anyone serious about this market. And we have a compelling stack of sources today. They cover a live crypto case study, the specific technical tools used to analyze it, and then the foundational, and I'd say non-negotiable process of backtesting, the thing you absolutely must do before you risk a single dollar.
Right. And our mission is to connect all three of those themes for you. We want to show you exactly where this powerful institutional hype can clash with the cold, hard reality of real-time technical data, and what steps you need to take to build a strategy that doesn't just sound good, but, actually performs.
We have to. The market is constantly testing that difference, the difference between a great story and a profitable trade.
Okay, let's unpack this with a really timely case study. The XDC Network. Right now, the narrative around this token is just screaming bullish. XDC has been one of the top gainers recently, up nearly 3%, with trading volume soaring over 31%.
And that gets traders excited.
It does. So that kind of rapid demand, it's a huge signal for people.
And you can understand why. The network itself is built for institutional enterprise. It's focusing on real-world asset tokenization, trade finance. These are long-term, massive plays. So when you layer that on top of recent technical patterns, the bullish argument becomes, very seductive.
Okay, so detail those seductive arguments for us. Analysts pointed out that XDC just broke out of a symmetrical triangle pattern, and this pattern is almost identical to a late 2024 breakout that led to an unbelievable 800% surge.
So the setup looks explosive.
Exactly.
And beyond just the chart patterns, the fundamental news is backing it up. It confirms this huge institutional gravitation. We know a Brazilian asset manager, Vert Capital, plans to tokenize $1 billion worth of corporate debt on the XDC network.
$1 billion.
Over the next 30 months. Plus, there's a US-based ETF application that's been confirmed by the co-founder. It's under regulatory review that spills adoption.
And of course, market access for retail traders got a huge boost. The new listing on Binance.us on July 30th, it immediately captured 63% of the token's $84 million trading volume in that window.
Right. So if you're betting on institutional flow, on historical patterns repeating, it looks like a slam dunk.
It does. And here's the critical pivot. This is the moment the narrative hits a technical wall. If you rely purely on the current real-time technical analysis, our sources show the daily summary for XDC suggests a strong sell signal.
And there's the conflict.
Wait, how does that even work? All that bullish momentum, the pattern confirmation, the ETF news, and the cold indicators just say strong sell. Isn't that technical analysis maybe flawed? If the market structure is fundamentally shifting with new listings like Binance.us?
That is the key question, isn't it? And it shows exactly why we have to understand these indicators so deeply. They are, by nature, backward-looking, but they tell you what the market is doing right now, regardless of the news. And in this case, the Relative Strength Index, the 14-day RSI, is sitting at 42.938.
Okay.
And that is a clear sell signal. It means momentum is weak.
And what about the other specifics?
The moving average convergence, divergence, or MACD, is right at 0. Also a sell flag. But what's fascinating here is the volatility, or, the lack of it. The average true range, the ATR, is just 0.00023.
Which is tiny.
It's tiny. Given the asset is priced around 5 cents, that number signals that despite the volume spikes, the price is actually flat. It's stagnant and it's consolidating, just grinding sideways.
So we have this institutional excitement pushing the price story up, but the underlying momentum and strength indicators are saying, hang on, this asset is stalled and losing steam right in the middle of its range.
Exactly.
That tension is why you need the tools to validate that emotional trading impulse.
Absolutely. So let's talk about those tools. Technical indicators. For anyone diving into this, their main function is to be mathematical tools. They analyze price trends, volatility, and help you quantify risk and, crucially, reduce your emotional exposure.
And for anyone learning, categorization is king. You don't want a messy toolbox. Our sources break them down into 4 really necessary types.
First up, you've got your trend indicators. They're all about market direction. So think moving averages, MAD. Second are momentum indicators. They measure the strength of buying and selling. That's your RSI, your stochastic oscillator.
Okay, and third would be volatility indicators, which track how much the market is fluctuating. So Bollinger Bands and that ATR we just mentioned.
Right. And finally, volume indicators, which analyze the trading activity itself. Things like on-balance volume or OBV.
Let's focus on the application here, not just the definition, because I think our audience knows the basics. So the RSI.
Okay, the RSI, it measures the speed and change of price moves. We all know the standard rule, over 70 is overbought, below 30 is oversold. But the real professional insight is about the center line.
The 50 mark.
Exactly.
Yeah.
When an RSI is holding strong above 50, it confirms a healthy uptrend. But when, like in the XDC case, it slips down to 42, even though it's not at 30 yet, it's signaling that buying pressure is losing the battle. The asset is consolidating, maybe even reversing. It's an early warning.
That reframes that XDC sell signal perfectly. It wasn't that it was oversold, it was just confirming a loss of momentum.
Precisely.
Okay, let's move to moving averages, specifically the exponential moving average, the EMA.
The EMA is faster. It gives more weight to recent prices. And we all know the famous one, the golden cross, where the 50-day EMA crosses above the 200-day. But here's a layer of professional nuance. A lot of institutional traders use slightly modified EMAs like the 55-day and the 233-day.
Why the specific non-standard numbers?
They're based on Fibonacci sequences 55, 89, 144, 233. Many pro systems rely on these ratios instead of the simple 50 and 200. It's a way of using trend tools that, frankly, many retail traders just overlook.
That's a great technical insight. Okay, and finally, the MACD.
MACD is fantastic because it's a trend and a momentum indicator all in one. It's comparing that fast 12-day EMA with the slow 26-day EMA. When the MACD line crosses above its signal line, that's the 9-day EMA, that's your bullish crossover. So in the XDC case, seeing the MACD 8 suggests those fast and slow averages are basically on top of each other.
Meaning no direction.
No direction at all. It just confirms that low ATR reading we saw earlier.
So if the indicators are telling a unified story low volatility, weakening momentum, what do? You don't just trade on one signal, you combine them. This is the critical advice, right? Combining two or three, like MACD plus RSI, is essential for confirming a reliable setup.
Right. The signal tells you what might happen, but you still need to validate that your strategy actually works. And that brings us to the process that separates the pros from everyone else. Backtesting.
Okay, so if indicators are the parts of your strategy, backtesting is like the 10-year road test in a simulator. Totally risk-free. You're evaluating your whole system by applying its exact rules to historical market data.
And the benefits are profound. It lets you do a meticulous risk assessment across all kinds of market environments, bull runs, crashes, everything. And crucially, it gives you optimization insights and helps you spot logic flaws before you put real capital on the line. You know, successful backtesting builds something more valuable than just confidence. It builds realistic expectations.
And what I'm hearing is that a simple, single-run backtest just isn't enough for these complex, non-stationary markets like crypto.
Yeah.
We need more rigor. Our sources detail 3 powerful methods for that kind of advanced validation.
The first one, which is essential for checking adaptability, is walk-forward backtesting. Think of it like a football coach who adapts a play after every single quarter instead of just using the same strategy from preseason training.
Okay, that makes sense.
You divide the historical data into segments, say, quarterly. You test your strategy on Q1, you optimize the variables, and then you test that refined strategy on Q2 data. It ensures your system is robust, that it can adapt.
That makes it much more tangible. But what's the second method?
Multi-asset backtesting. This is where you take your system and you apply it across different asset classes, crypto, Forex, stocks. You want to know, does my strategy only work when Bitcoin is pumping? Or does it also work on stable currency pairs? It helps you find the optimal environment for your system.
And then there's the most sophisticated one, the one that needs some real computing power, Monte Carlo simulations.
This is a statistical beast. It's not just replaying history. It's generating thousands of hypothetical scenarios using random sampling. It creates a complete distribution of possible outcomes for your strategy.
And why is that better than just a standard historical test?
Because it models the risk of ruin. A standard backtest gives you one historical result. Monte Carlo gives you the probability that you will hit an unacceptable loss under thousands of different conditions. It answers the big question. Even if this thing makes money, what's the statistical chance it completely blows up my account?
Wow. Okay, so once that intense testing is done, you can't just look at the total profit. You need to interpret the results with specific metrics.
Absolutely. You have to go beyond simple win rate and total T&L. You must obsess over risk. And the single most important risk metric is maximum drawdown. This is the biggest peak-to-trough decline your portfolio suffered before it recovered.
And that's more than just a number on a page, isn't it?
It's the psychological pressure test. Knowing, before you even start, that your strategy historically hit a 25% drawdown that prepares you for the moment it happens live. Most traders panic and quit right at that point. Minimizing that drawdown is essential for emotional survival.
Then you need the risk-adjusted ratios to compare strategies.
We lean on two main ones. The Sharpe ratio measures your return against a risk-free rate adjusted for volatility. Anything above 1 is generally considered acceptable. And then there's the Kalmar ratio, which is great for long-term strategies. It compares your average annual return directly against that maximum drawdown. It confirms if the pain was worth the gain.
This brings us to our final and maybe most crucial section, the pitfalls. Because if indicators give signals and backtesting validates the strategy, the greatest danger often comes from trying to skip all that hard work, usually by looking for quick fixes, like trading signals.
Look, if you're new to this space, this part right here is your biggest hazard warning sign. Signal providers prey on a lack of risk management knowledge. And the first, simplest deception is measuring performance in pips instead of the only metric that matters: percentage.
Pips sound so official, though. Why are they meaningless?
Because a pip's value is variable. It changes based on the asset, your position size, your risk. I mean, a pro could show an account that's up 200 euros, but at the same time show a historical loss of 470 pips.
Yeah, how?
Because they manage their risk correctly. Pips are a vanity metric. They're designed to impress beginners.
That exposes a huge vulnerability. Okay, the second big scam is the 90% success rate fallacy.
That phrase should make any experienced trader laugh out loud. These guys are only showing you the win rate. They get these high rates by taking tiny quick profits, risking $100 to make 10. They keep winning these small trades.
But the losses?
The 5 to 10% of losing trades, they let those run until they become catastrophic, wiping out 80% of the entire account.
So what does a realistic professional success rate look like?
The best asset managers often have success rates below 40%, sometimes even closer to 30%. Their whole focus is on massive risk-to-reward ratios, like 1 to 6 or 1 to 8. They lose $100 most of the time, but when they win, they pull in 600 or 800. It's about capital preservation, not being right all the time.
And for anyone offering free signals, there's a huge conflict of interest, right? Usually tied back to the broker.
Yes. Free signal providers are almost always paid by, let's say, non-trustworthy brokers through hidden schemes. It could be a flat fee or a commission on every single trade you take, win or lose. Some brokers even let the provider increase the spread by 2 or 4 pips.
And that extra money goes right to the signal provider.
Straight into their pocket. The client is unknowingly getting the absolute worst rates and paying a hidden commission.
So bringing it back to strategy validation, even when you backtest honestly, you still face pitfalls that can ruin your results.
The most common is overfitting. This is when you optimize your strategy too perfectly for your historical, your in-sample data. The result is a system that looks incredible on paper, but performs terribly on future out-of-sample data.
And the solution?
Always testing on market data that was not used during the development phase. That's how you check for genuine robustness.
Then there's the issue of selection bias.
That's survivorship bias. It's insidious. It's when you ignore assets that failed or got delisted during your test period. If you only test against the winners, your results are going to be unrealistically optimistic.
And finally, a really simple but deadly mistake: ignoring real-world trading costs.
If you don't factor in everything, transaction costs, commissions, slippage, the spread into your backtest model, your strategy will perform significantly worse in real life than your report suggested. You have to reflect the full cost of doing business. At the end of the day, the path to sustainable profit requires rigor and education. The best strategies need a full plan, high-quality data, and continuous refinement using advanced techniques like walk forward or Monte Carlo. And professionals all agree. Signal services rarely benefit the followers.
The core takeaway here really is that proficiency comes before profit. You can't win a Formula One Grand Prix by trying to copy Lewis Hamilton's exact curve in a corner before you even know how to drive the car. Education, especially in risk management and validation, has to come first.
And, we noted that markets are non-stationary. They're always changing, which is why that walk-forward testing is so vital. So given that backtesting only shows how a strategy performed in the past, and past performance is never a guarantee of future success, it leaves you with this one big question. How can you use tools like Python or machine learning, which are designed to adapt and evolve, To build a strategy that doesn't just predict the past, but dynamically learns and refines its rules from the very moment it hits the live market. That's the question driving the next frontier of trading.